Welcome to this panel event on the last day of the Global Ethical Finance Initiatives Conference for 2020. Really pleased to welcome you to this panel, Greenwashing, Time to Name and Shame, or Name and Fame. I'm Kaisie Rayner and I'm Climate Change Lead at Royal London Group, and I'd like to take this opportunity to introduce you to all of our panelists before we get into the nitty-gritty questions. Firstly, I'd like to introduce Rebecca Jones, who is founder of New Money, David Hickey, Portfolio Manager and Responsible Investment Lead at Lothian Pension Fund, Alex Smith, Head of Strategic Policy, including Sustainable Finance at the FCA, and Jill Jackson, Managing Director of the Big Exchange. So I'm going to jump straight in and come to you, Rebecca, first. You published a report earlier this year, a guide to greenwashing. What did you find? How bad is it out there? And are customers being hoodwinked? What should they be looking out for?
Yeah, it's terrible. It's really bad. And they're being very badly hoodwinked. Yeah, is the very short answer to that question. We did a lot of research looking at the active and passive area. And it would be no surprise, I think, to most people to learn that the biggest problem is in the passive area, because by their very nature, it's extremely difficult to do any kind of selective investing using passives. There are people out there that are trying. Ticker is of a notable exception. They're really trying to do some good work in the passive space, but generally, you know, the biggest problem that we have in this area are very large asset managers who shall remain nameless, BlackRock, who are issuing ESG ETFs that mean absolutely nothing. And unfortunately, because of this race to the bottom with prices, they're the things that are attracting most of the money. I mean, we had a look at the EU space, and of the 2,405 sustainable funds that are listed, that's active and passive, only 16 screen out fossil fuel, and 160 say anything about fossil fuel. So yes, it's a big issue.
Those are quite stark numbers that you're presenting there to us, Rebecca. So only 16 funds and only 160 in total out of 2,405. If you do the quick maths there, those are not great numbers, and it's certainly something to be concerned about. I know we have Alex from the FCA, and Alex, you will absolutely get an opportunity to jump in, but I'd like to come to David first. And ask you, David, as an institutional investor, we're also seeing massive rise in the number of institutional investors claiming to be responsible investors. We've got over 2,000 signatories at the PRI representing over 80 trillion in assets. What's your view on this as a responsible investor yourself? Is this all responsible investment? What's the truth?
Yeah, it's a really good question, Kaisie. With regards to this kind of rise in AUM that's managed responsibly, I think, you know, going back to the previous panel, they mentioned that there's a problem in taxonomy and how we actually refer to all of this kind of stuff. What do we mean by ESG and what do we mean by responsible? Now, for me, ES and G are three investment risks within, you know, many investment risks that any investor takes. Responsible investing incorporates ESG and lots of other things like, you know, correct stewardship, voting, engagement, things like this. So, you know, if you're looking at what is managed responsibly, if a company has a good engagement program, it has good voting policies, then the chances are it is managing responsibly. Now, if you look at passive versus active, you know, you can look at risk in terms of, you know, we believe that carbon emissions are a risk and therefore we don't want to take it. So we want to tilt away from that. That's a risk thing. That's not necessarily a responsibility or an ESG thing. So I think one of the problems is that we as investors confuse a lot of different things into the same point and say, this is greenwashing, this is not greenwashing. And to pick up on another point that was made by George in the opening and Ellen and David in our last panel meeting, you know, what does it even matter when you're talking about secondary equities? And, you know, I say that, you know, it's a bit of a glib comment, but, you know, if I sell Shell, a global oil company, and I buy Orsted, Orsted, who are, you know, green energy and wind farms, it makes not one iota of difference to either Shell or Orsted. Because, you know, I am buying from another market participant and I am selling to another market participant, and there's no change in capital at those companies. So I think, you know, this idea of kind of green investment in equities and divestment in equities, I think it simplifies the very real issues that we're facing in getting capital to the right areas from our long-term investment pools like pension funds.
Quite a different perspective coming through there from institutional investor perspective from David. Does it really matter if you're excluding Shell, if someone else is really going to pick it up and own it? And I guess that kind of contrasts with, Rebecca, your views from the report that you've done, where actually customers have pretty strong views on where they think their money should be invested and are not necessarily thinking about this kind of broader piece of who buys it when they sell it. And maybe onto that point, so coming back to Alex, you've heard from Rebecca and David. How do their comments align with the FCA's views, and how will the FCA be helping customers navigate the minefield, and what kind of pitfalls should advisors be looking out for?
Morning, Kaisie. Morning, everyone. Actually, what's really interesting is we're in really strange times right now in the middle of this coronavirus pandemic, and yet the focus on climate change and sustainable finance remains right at the forefront of the agenda. And so there's lots in there that Rebecca and David mentioned that I'd love to kind of pick about and have a good discussion on. But I wonder if, to frame it, it's worthwhile just taking a quick step back and kind of talking a bit about what we as the FCA look at and kind of our wider work in relation to sustainable finance. So we very much look to add public value. That is what we do, and that is established through our mission. And really our whole philosophy around the sustainable finance market is to create a regulatory environment where firms can capture both the opportunities and the risks that climate change and the transition to a green economy presents. So last year we went with our policy statement, really setting out where our initial focus will be on climate change. That identified three outcomes. The first is ensuring issuers provide the market with decision useful climate related disclosures. Secondly, we want to ensure that firms consider the material climate related financial risks in making business risk and investment decisions. The third, which is most relevant to our conversation here, and that's making sure that consumers have access to the financial products with the right information and advice to be able to make informed decisions. So that we know there's a growth in this market. We know that this growth has continued throughout the period that the coronavirus has been with us. But as this market continues to grow, I think one thing we can all agree on, both from a regulator, firm and a consumer perspective, is that we want to make sure that trust in this market is well founded, well placed, and can be relied upon. So to do this, we are clear that firms should understand what their obligations are and that they should be providing information to consumers which enables them to make informed decisions. And that information should be fair, clear, and not misleading. And that was at the heart of the evidence we gave to the TSE decarbonisation inquiry just last week. And to tackle that, we're doing a few different things. We've got multiple initiatives underway. The first is to improve the information that's flowing through from investee companies through our proposed TCFD aligned rules for premium listed issuers. We're working right at our authorisations gateway to ensure that products that are authorised in the UK, including green and sustainable funds, present information to consumers in a way which is fair, clear, and not misleading. We're undertaking policy work to design and focus on the design and disclosure of retail investment products. We're also supporting common standards of kind of sustainable finance approaches right across the UK, but also internationally, such as participating in IOSCO work streams. And of course, we're working in the UK government, the Treasury, around how some of the EU initiatives might be implemented in the UK. So I kind of wanted to set that as a framework that we can kind of come back to as we start to unpick some of the challenges that exist around greenwashing.
Great, thank you ever so much, Alex, for the overview of the FCA's work. There's a lot in there that's going to relate to some of the things and the discussions that we're going to get into. I do sense we're chomping at the bit, so I'll come to my final introduction. Jill, lovely to introduce you as Managing Director of recently launched Big Society platform, I'd like to ask you a big, profound question. How do we build a fairer financial system that works for everyone? And what role do green or sustainable funds have in making this happen? And maybe we've all missed the point. Maybe we're all fixating on the wrong things. And if we are, can you tell us what those are?
Morning, Kaisie. Just to confirm, it's the Big Exchange, not Big Society. Otherwise,
sorry,
might give us into trouble for that. For me, I think it's not just about green funds. I think it's about all funds. I think that for consumers to be able to make informed choices, we can't restrict this transparency of information just to funds that label themselves as green. I think if we look at some of what's going on in the pension world just now, we can see that people are not aware of where their money's invested. People want to know that, they want to be able to understand it, and that transparency that Alex talks about is really important in that. We've talked about already green, sustainable finance, responsible investing, sustainable. That can be really confusing for a UK consumer to try and get their head around that. Rebecca's report that she issued earlier this year does a great job of trying to help people understand the differences between those things. But for me, transparency is key, because without that, people can't make informed choices. And whether we all like it or not, we can call something responsible, sustainable, green. People will decide whether they believe it's responsible, sustainable or green. So the only way they can do that is with access to the information. The labels can't replace the substance of what the investment is. And I think that that's something that we all need to be really cognizant of. So I don't think we're fixating on the wrong things at all. I think we're all trying to drive for transparency in the same way that we've recently improved transparency on charges for financial products, that you've seen that change throughout the years, and it makes it much easier for consumers to understand. I think we've got work to do here. The positive thing is that people are keen, there's appetite for it, consumers want it, the industry wants it. So I think it's just about us all making the progress that we can as quickly as we can to help people make these choices.
Great, thank you, Jill. That's opened up the conversation, and I think it's going to take us to the next question, and this is one for all of you to participate in, but I'd like to come to Rebecca first. So Jill, you mentioned that Rebecca's report has done a great job of trying to explain the differences between some of these naming conventions that we as industry use that sometimes don't make any sense to anybody other than ourselves. So Rebecca, I'd like to give you the opportunity to talk a little bit about some of the differences between these things and what you might have discovered in your report in terms of the types of funds that align to those descriptions.
Yeah, sure. So, I mean, the labeling issue is an interesting one. And as I mentioned before, people can get a little wrapped up in it, and I completely agree with Jill that what's important is transparency. So before I kind of go into what we did, I'd just like to say on that point that there is a wonderful lady called Georgia Stewart who has a company called Tomello, and she did some research which really blew me away when I saw it, and it was around the time I was writing the pensions guide. And she was trying to develop a whole new labeling system for mainstream FTSE 100 stocks, because a lot of the time when people look at their portfolios, she naturally assumed that they don't know what they're looking at, right? That these company names, people don't know what they're looking at. What she found with the research that she did by kind of pounding the streets and also just speaking to investors was that people did know who Nestle was and who BP was and HSBC and so on, and they'd already made up their minds. So actually all of this time that she'd spent with labeling and trying to create this new system of categorization was a waste of time, because people already knew, had some kind of sense whether or not their values were aligned with that company. So that's something I just like to throw in there, because that was something that really interested me. Now with the guide, we came up with something called the Green Grid, which looked at an odd number, 7 kind of different areas of sustainable investment, beginning with going from the sort of least green to the most green. So beginning with ESG, moving on to ethical, Sharia, responsible, socially responsible, sustainable, then green bonds, single focus, i.e. something that just invests in, say, renewable energy or gender diversity, and then impact investment, which is that stuff that really goes in and looks for kind of social enterprise typically to invest in. So a way of trying to frame those different labels for people. And we had some good feedback. People said that that helped to make things a little clearer, but still, you know, 7 labels is a lot. And my thinking has actually evolved a little bit based on Timello's research and what Jill was saying. And actually, I think that the key really does have to be kind of transparency. And I personally would love to see a kind of evolution in fund labeling, which asks fund managers to put right up front on their key documents what they're holding in harmful sectors. So by harmful sectors, I would mean harmful against people and planet. So fossil fuel, arms, tobacco, etc. And that would be great to see that on all funds.
Great observation there, Rebecca. And certainly, I think we spend a lot of time trying to differentiate between different versions of sustainable. And talking to one of my kids about that, they were like, but hang on a minute, like, why don't you just tell people all the other stuff is like junk food? You don't put health warnings on carrot sticks, do you? So I like the idea that it's not just green and sustainable funds that need to be declaring what they're holding. Maybe it's all funds, so we can do a proper comparison. I'd like to come to David. So you picked up on one of your comments a little earlier. And, you know, there are some discrepancies when we look at sustainable funds, depending on whether they're the impactful type that Rebecca talked about at one end of the spectrum, a sustainable leaders fund, or, you know, a fund that's taking into account ESG risks. And one of the things that has come up is why would a sustainable fund be holding some companies that are considered bad? So, you know, it's possibly a surprise to retail consumers if they look on just a broadly managed sustainable fund to see that perhaps Shell is in there. Why might Shell be considered a good investment from an ESG perspective?
Yeah, I mean, I agree with what a lot of the other speakers have been saying. I think Jill mentioned earlier that it has to be all funds that are sustainable. And I think it's up to the investment manager to then have a look through and see, you know, is what I'm holding sustainable for my stakeholders? You know, the idea of someone like Shell or BP, how can that fall into a sustainable fund? Well, these companies are huge. They have massive cash flows, and they are currently attempting to pivot their businesses away from fossil fuels and towards renewables. Now, a lot of people, you know, will roll their eyes at that and say, well, that's impossible. Well, we've actually got examples where it's happened before, where the Danish oil and natural gas company divested of all its oil and gas holdings and became a renewable company. Can they all do that? No, they can't. You know, because, I mean, let's face it, industries decline and industries don't pivot, but companies do. Now, you know, if you want to have a sustainable fund, you can look at it and say, well, we're going to buy good companies that don't do evil activities, whatever your interpretation of an evil activity is. Well, you know, there's a point of that saying that's kind of pointless, because they're already doing it. So you can either align your interests with that. And I don't think there's anything wrong with aligning with that, because, you know, I think that as an investment decision, you know, buying companies that are doing good things, you know, it may be a very, very good investment decision going forward. So I don't think there's a problem with that for private individuals. But at the same time, you know, we as institutional holders, as universal holders, you know, between you and I, Kaisie, I believe we will own most of the market within our institutions. So what you can do through engagement and working with these companies, you can try and imprint your company's values onto some of the decisions that they make. You know, we can go to Shell and say, you know what, we don't think that pumping more money into oil and gas exploration is a good idea, because we think that, you know, those assets are going to end up stranded, and you may be better off taking the cash flows from your existing projects and putting them into renewable energies, which we believe is the future. And you can use that as part of the capital allocation argument by steering the companies in the direction that you want them to go. That, I would say, is responsible, and that, I would say, is sustainable.
Great. So again, teasing out some of these big differences between an institutional investor's perspective, where you're holding the whole market, and I agree, as Royal London Group, we do invest our 100 and something billion across lots of assets all across the world. But I guess there is a difference if you're an individual investor and you're looking to align your values with your investments. I'd like to ask Alex for your views on this, or the FCA's views on the appropriateness of including Shell in a sustainable portfolio. And then I'd like to come to both Jill and Rebecca for your views from the retail investor's perspective as well.
So I think it's really interesting, because I'm going to agree with some of what I think David has just said. There seems to be quite a lot of focus on something is good and something is bad. And actually, I think the reality is the world isn't necessarily like that. And investing in sustainable funds is exactly the same. It's varying shades of green. At the FCA, we aren't here to tell people, or indeed funds, where they shouldn't invest. Fundamentally, that's an individual decision. But the reality is that consumers need to be able to make that in an informed way. And actually, the point I think David was trying to pick up there is that there may be some circumstances where a sustainable fund, a green fund, whatever it is, holds certain assets which may, on the face of it, think, well, that looks a bit strange, but actually really effective stewardship that's focused on activities and outcomes, not just policies and processes, can actually have a really positive impact. The important thing for us as a regulator is to really make sure that consumers are understanding. So when they are looking to invest, they're getting information which is clear, fair, and not misleading, which enables them to make an informed decision about where they put their money, to ensure that the funds they're investing aligns with both their financial and non-financial objectives.
Just before I come on to both Jill and Rebecca for their views, Alex, I'd like to push you a little further on that. Absolutely, the FCA's rules and regulations around helping us be fair, clear, and not misleading. Absolutely, I get that. I think for me, what I'd like to really ask you is, echoing the panel's naming, is what should the regulators do when they find greenwashing? Is it a case of using the carrot or the stick? And are you likely to name and shame?
So I don't think we are in the business of naming and shaming unnecessarily. There are times when we do. That has to go through kind of due process. But actually, fundamentally, I think what we need to do, I think it's in all of our interests, is to build trust in this market. And the way to build trust in this market and not undermine that trust is to make sure that disclosures, information, firms, funds are not misleading consumers. And so actually, a bit of a kind of call to people on the panel, but also those in the audience as well, is where we see funds or products that are failing to meet that fundamental test, we will challenge them. And we need to know about those cases. If you are seeing them, if you have concerns, please share those examples with us, because fundamentally, it's in all of our interests to make sure that consumers get outcomes, can invest where they want to, aligned with both their financial and non-financial objectives, and actually the trust in this market can genuinely be held by consumers.
Great, thanks, Alex. Now, Jill, I'm going to come to you first, and two questions for you around that. So Alex has talked about fair, clear, and not misleading, but certainly in my mind, that doesn't necessarily equate to understandable by the average person. So I'd like your kind of perspectives, given the work that you've been doing in looking at what's really inside funds, as to the degree to which they're understandable by a normal person. And then we can maybe come on to that difference around what does a retail investor think when something's called sustainable? Are they expecting to see Shell in there? And if you can give us your thoughts on that too, that'd be great.
Yeah, sure. I think it's really interesting, the points that have been made so far about whether somebody would expect to see Shell in a green portfolio, right? That's a question that can only be answered by the consumer. The important thing is the consumer has to know that Shell is in there and understand why it's there. And as you say, Kaisie, that can cause difficulty in terms of the amount of information that you're giving somebody to make a choice. If you're giving them all the risk information they've got to have, all the financial information, and then you start layering in all the values aligned information, it can become quite overwhelming. I think there's lots of ESG ratings agencies out there. I've got no doubt we'll come on to talk about that in a while. There's you know, you can get the same company rated in many different ways from different ratings agencies. I think the approach that we've taken is that we've looked through all the portfolios for the funds that are held on the big exchange, and we've had them independently assessed, and we've allocated each of them a medal depending on the positive impact they create. And that's underpinned by the UN Sustainable Development Goals. There's weightings in there for how transparent the asset manager is, so that people can see at the highest level the impact that it's creating, but they can then drill down and get further information. Now, there is definitely more work to be done on transparency. We would like to see even more transparency across the asset management industry. And there are some great examples of that out there. One of our founding partners, Web, are really transparent about where their portfolios are held. And I really encourage the industry to do that more and more. David's an institutional investor. He's got the benefit of always knowing exactly every company that is in everywhere he invests, right? Whereas the retail consumer doesn't get that benefit just now. They get a fact sheet that's maybe got the top 10 holdings. That's the only information that they've got access to. And I think this real drive to change that, but also distill it in a way that is relevant to the customer is really important. So if you can try and distill it and layer the information, I think it makes it a lot easier for people to understand. I know it makes it easier for me to understand, and I'm from the asset management industry. So I think it's for all of us to take responsibility for that. And as Alex said, the most important thing here is the trust in this sector. It's really hugely important that none of us compromise that in any way. And if something does hold shell, say it holds shell, say why it holds shell, tell the customer that the reason you've bought it is because you want to actively engage. Then the customer can decide whether that fits for them or not. I think the difficult thing with the labelling is that it creates perceptions amongst people. And for me, if something said it was green and then it would hold shell, personally for me, that would seem like a complete contradiction, right? I wouldn't be comfortable with that. If something said it was sustainable, I maybe would even have a problem then if it held shell. But if somebody could explain it to me why they held it, I could maybe come to terms with that. So I think this is, again, comes back to the transparency point. The more information we can give people in a meaningful way that's relevant, then the better the outcome will be for all of us. And that means owning the mistakes as well. So if you hold something and something goes wrong, it means telling people that, saying that it's gone wrong, telling them what you've done as a result, and making them feel comfortable that you're being good stewards of their money.
Completely agree, Jill. So coming on to you, Rebecca, having looked at 2,405 funds, you must have had to wade through some information. What's your perspective? Is it fair, clear, and not misleading? And importantly, is it understandable, and can it be understandable by an average investor?
Well, to be fair, we did not wade through all of that. Myself and Anna Fedorova, we had some help from Morningstar and others. So, full disclosure on that. First of all, I'd like to put a question to David. David, do you know the average percentage of revenue that oil and gas companies spend on developing renewables?
Of revenues or of CapEx plans?
Of revenues, the average,
not off the top of my head. I know that someone like Total will invest around 20% at the moment of their CapEx revenues on renewables projects. So that's about 3 billion out of 15 billion. So, that number, in my opinion, is currently too low. And when I speak to the company, I would say, I would like to see that that CapEx revenue into E&P reduced, and the transition-minded CapEx increased.
Okay, so the answer is 3%. The average revenue spent by oil and gas companies on developing renewables is 3%, and you can check out Project NOAA for their data on that one. So the issue here is that there is a lot of really great work that gets done on that institutional pressure level. Church of England, fantastic example. Church of England with Climate 100 really leading this, and they're listening to their members. And because they're listening to their members, they're going to Shell and they're forcing Shell to link executive pay with climate targets, right? So that's fantastic and that's awesome, and more of that needs to happen. And that happens because institutional investors are listening to their investors who do know what they want and do know what they believe in. I think that often, you know, because we live our lives in our kind of asset management bubble, we think, oh, the average person couldn't possibly understand this. It's actually not that hard. I kind of got to grips with finance in about 6 months, having been a music journalist for a year. It's not that tricky, you know, and people have already kind of made their decisions. So, you know, and often, you know, on fairly informed basis. So to kind of go back and say that transparency is absolutely the key, but that doesn't mean that, you know, pressure shouldn't be put at the institutional level on oil and gas companies to make things better. As for how we continue to kind of push the debate forward with labeling and how we try to make things slightly clearer for people, I mean, for me, it really is just all transparency. And I don't know, has anyone paid attention to the Make My Money Matter campaign? Has anybody been following that?
Absolutely, absolutely. I think there's the question coming up. It's like you've read my script ahead, but happy to move on to that and have that discussion. So there's the Make My Money Matter campaign is amazing and wonderful, and I think certainly from my perspective, it's driving the right conversations. But my question around that to each of you is, you know, Making My Money Matter, absolutely great as a concept, but what do we need to focus on? So we can talk about greening our portfolios, but that doesn't necessarily mean we're going to end up in a green world. How do we manage that disconnect between setting a net zero target across small asset pools and driving change in the real world around us? Because our customers, who are pension customers, they don't retire into their portfolio, they retire into the real world. So how do we resolve that conundrum? And Rebecca, seeing as you raised the Make Your Money Matter, let's start with you and let's get your perspective on that.
Yeah, sure. Well, actually, before we jump into that, I was going to talk about something a little bit less technical, which is they worked with Share Action, or rather they used Share Action's video, in which they went out onto the street around, I think it's around King's Cross Station, and they showed people around King's Cross Station their average pension portfolio, and every single person was horrified. Every single person was horrified. People do not want their money going into oil and gas, coal, arms, tobacco. That's not the kind of world they want to live in, you know? And if you want to kind of explain that away with, oh, but we need to do this and we need to do that, okay, fine, but you've got to listen to people. You know, if you don't listen to people, what are you doing? You know, you're just investing their money how you want to without actually engaging them. As for net zero, yeah, really interesting. I kind of love the way the UK went into it, actually. You know, yeah, we're going to get to net zero by 2050. No idea, zero idea how that's going to happen, but we're just going to kind of gun for it. And then Aviva has recently signed up to the campaign to say that they're going to do the same. And I think I heard that even Amazon is now saying they're going to go net zero. Zero idea how we're going to do it, but we're going to try. The intention is great. The practicality, not clear, but you know, and so much of human history, invention has come because there is a need and because people have tried. So fingers crossed, I guess.
I'm going to come back to some of our other panelists who would like to jump in on the green your portfolio or green the world conversation. David, your microphone.
I'll take some of that. I mean, it's in line with what I was saying before. You know, this greening the portfolio is not the same as greening the world. It simply isn't. Where people might want to say, well, I don't want to invest in this. Don't want to invest in that. It's like, fair enough. If you don't want to, you don't want to. But at the same time, divesting those things isn't going to change the world. It doesn't, because divestment means that you have to have a buyer on the other side. So, you know, that share doesn't just disappear. That funding isn't drawn from the company. The answer is not in equity. It simply isn't. The answer is in other forms of investment. The answer, you know, we had our panel, the last panel on was talking about green bonds and sustainable bonds. Absolutely brilliant. This is primary capital. This is new money, or it's refinancing for companies. This primary capital, you know, you plug it into the company and it's spent on new projects. You know, this is real impact stuff. When we're talking about private markets, infrastructure, things like that, you know, you can plug in primary capital and get real impact stuff out. You know, my organization, Lothian Pension Fund, you know, we own wind farms, we build wind farms. You know, this is real stuff. You know, you're not doing that by putting money into a slightly greener equity than the one you're currently in. And the unfortunate truth is, and you and I have spoken a lot about this, Kaisie, is that those opportunities aren't open to the average investor. You know, it's very, very difficult for the average investor to be able to buy good infrastructure projects because these things are inherently illiquid. And yet a DC pension investor, defined contribution pensions investor, has got to have a liquid portfolio, because despite the fact that they're investing in, you know, for 40 years or so, they need to be legally able to liquidate that in a day and move it to a different provider. So there are structural problems in getting people into these, what I would call the right things. And I think it's in line with what Rebecca's saying and what Jill is saying. You know, I think if people could invest in these projects that are aligned with their values, and they were making what I call a real, you know, marginal investment, an impact investment, I think there'd be a really big interest in that. I think that's where Make My Money Matter would like to see things, but they're talking again about equity, which I still think is the wrong place to be talking about this. I mean, maybe it's a question for Alex, you know, is there a way of changing fund structures? You know, are there new structures that we can invent that will allow more illiquid investments to go into long-term pension pots for private investors? But on the flip side of that, we all saw what happened with Woodford when he had illiquid stuff in his portfolio and people tried to get out, and then we ended up with locked funds. So, you know, you've got this on both sides. So we need to sort out that problem. How do we get illiquid projects into the hands of private investors that really want to make an impact?
So good question for Alex there. So how do our pension customers get wind farms in their pensions? Is this something the FCA is thinking about already? And do you have an answer, an innovative new answer to solve the problem for us?
So look, I think it's the FCA's role to make sure that funds are channeled into certain investments. That's not our job, but it is our job to make sure that actually where throughout the whole value chain people want to invest are able to do so. And in danger of kind of repeating, but Jill started to pick up on this, and I think is absolutely right, that actually for us it's about the information and transparency which goes throughout the chain. So at the moment we're starting on premium issuers. Next year, we're going to be turning our attention to how asset managers and contract-based pension scheme providers can bring greater transparency. But actually, all the way down to the end-user investor, I think that some of what we've been talking about here today is actually, should it hold this? Should it hold that? Fine, okay. Fundamentally, consumers will have different needs. Can they make an informed decision? And I think there's a real worry that very often firms can trip into providing information to consumers because it will help them sell more investments or it minimises their legal risk. And I just feel there's a fundamental mindset shift that's needed here to understand what's really driving consumers to invest in sustainable funds and helping them, give them the information to make an informed decision. And I think if we can see that flipping mindset, then actually I think we'll start to see consumers being, okay, I do know what's in my pension fund, and actually, no, I don't want it there, I want it there instead. And so I think, which is a point I think Jill was trying to make, is it's about that transparency and the information flow throughout the chain.
So Jill, back to you. And you've been listening to some of the things that both Rebecca, David and Alex have been saying. I'd like to invite you to comment. And also, if you have any views on Rebecca's challenge to us institutional investors of stop just putting money where you think it needs to go and start listening to your customers.
Yeah, I mean, listen, we're all consumer-led businesses, right? Without those customers' money, you don't have a business. So it would be an unusual business to not listen to what customers have to say, right? So that's basic business, right? So, but I think for me, one of the things just on David's point about the impact that Make My Money Matter campaign can have, the big exchange can have in terms of getting people to put their investments aligned with their values and move away from things that they feel don't reflect how they live their lives and how they want the future to be. I want to believe that we live in a world that matters. Individually and collectively as a society, all of our actions matter. We're all being told that every day. Take the bus, buy less single-use plastic, you know, don't use your car often. We all try and minimise, more and more now, we all try and minimise our impact that we have on the planet, right? And I think investments is just an extension of that, whether we like it or not. It's as simple as that. It's like, if I choose to buy an electric car, then I don't want to fund fossil fuels. If I choose to not smoke, encourage people not to smoke, I don't want to fund tobacco. It's an extension, it's a reflection of your attitude and what your values are in life. And I think by simply saying, well, you can do that, but it doesn't have any impact. Well, it does have an impact to me, because then my investments reflect my values. So the impact to me is instant, because I then know that my investments are creating a change that I am proud of, I'm happy to be associated with. And I think that that's something that we can't lose sight of. This stuff matters to people. People are changing the way they behave in everyday life to try and protect our planet and help society. So we can't then disconnect that completely from investments. And any kind of awareness of pensions is great, right? Because some people don't even know their pension money is invested. So any awareness about pensions is a really super positive thing for everybody in our industry. It's really important that more and more people understand that. So for me, I suppose I would just like to give hope. I think for me as a consumer, I want my changes to be reflected in my investments. I want that to happen. I want my kids to be able to do that. I want them all to, the future generation, for this to be quite a natural extension of how they live their lives. So yeah, I think as much as David's making his point about the primary, secondary market, it's about more than that. It's about, does this investment reflect how I live my life? That's what it means for me and many others when you see a lot of the research that's coming to the market just now.
Thanks, Jill, for your comment. So I'm now looking at the screen. So this wonderful digital conference has the ability for me to receive questions from digital participants and then put them to you. They are now appearing on my screen. And one for you first, Rebecca. Rebecca mentioned Tomello, who have also worked with LGIM to allow investors a say on voting decisions managed by LGIM. This is a really important development and can give the end saver a voice. Please can the panel comment on this?
Shall I go?
Yes, Rebecca, you go first, and then we'll open up for wider comments.
Yeah, this is really interesting. So this was kind of how Tomello started out, is being able to connect people as shareholders to their shareholdings and give them the ability to vote. There's a journalist called Mark Atherton who writes for The Times. Now this has been a particular bugbear of his for maybe like 20 years, not to give Mark's age away, but this is something he's been very passionate about. Every single time he's gone to an asset manager or suggested the idea, they've laughed him away. Like, how can you possibly give, you know, people that have £10 in a Shell, we're using Shell a lot, let's say Aviva instead, you know, the ability to vote. So Tomello's solution, which is trying to do that, is just amazing. And it would be wonderful if there was some way to give people en masse the ability to have their views expressed at the companies that they invest in. Sadly, I don't know if anyone's following what's happening in America, but the SEC are now trying to legislate that power away because too many people are now apparently having a say. So hopefully the FCA won't do that when people start to have more of a say in the UK. But it's really important and really exciting. And very quickly, just to go back to, you know, pension funds in particular, or generally investors that are doing more than just looking at equity, David, I would point to Nest. And I think Nest is really important because it's now one of the UK's biggest pension providers, Master Trust, created after auto enrolment. And last year they opened up, I believe it was around 8% of the portfolio to unlisted investments with BNP, BlackRock, unfortunately, and a Monday helping them to do that. And I think that is just, I was so excited when that happened, because that's the model right there, is how we get away from just pension funds moving straight into the FTSE 100, straight into the MSCI world, is that you can actually open up a certain amount for unlisted both debt and equity. And then I learned at the pension conference that apparently the RBS pension fund has been doing this for ages, and they have apparently 15% in unlisted. So it's not impossible, and it won't all go bang, because not every manager has a God complex like Woodford.
Rebecca, wonderful comments. I can see the other speakers as you're speaking, kind of clapping in the background there. Brilliant, brilliant observations. I would like to come to you all, but I've got more questions. They're all firing in now. I've got another one that is quite punchy around, well, okay, I'm going to have to paraphrase. You talk about stewardship and engagement, but does it really drive outcomes? Something about perhaps all just sitting around drinking champagne and having a cup of tea and cheersing yourself. So I don't know who wants to take that one first. David, maybe that's one for you.
I'm quite happy to take that one.
I'm sure they're not directing it to you personally.
Does it have outcomes? Yes, it does. I will just say, yes, it does. You know, I think Rebecca mentioned the Church of England's pensions board earlier. You know, if you look at what they've been doing with the mine tailings initiative and things like that, you know, being able to change the behavior of international mining companies and work out where all the tailings dams are and come up with a brand new international standard to stop tailings disasters going into the future. That is something that has happened through collaborative engagement within the asset owner space. The asset owners, so people like, you know, pension funds, endowment funds, things like that, have a huge amount of very, very long-term permanent capital. So they're able to make a really big impact on that, because we're able to sit there and say, look, we do represent 90,000, you know, Lothian Pension Fund represents 90,000 key workers. These are, you know, council people, these are street sweepers, these are lollipop men and ladies, you know, these are, you know, real people down on the floor. And it's that who we represent, and those people collectively, and we get the views through our board, through our committees, councillors, through our union representatives, through our employer representatives, rather than individually through trying to get the views of 90,000 individual members, which unfortunately is impossible because we've tried it before, you know. But we're able to take what we believe is a reasonable snapshot of what their views are and try and implement that into where we're steering our engagement efforts. And we have huge amounts of success. We really do. Rebecca has badmouthed one particular company, BlackRock. We've been working really hard with BlackRock. We've been really pushing BlackRock on their terrible track record on climate voting. And through, as a direct outcome of that engagement, they joined Climate Action 100+. Now they're going to be working on that and engaging, using their huge amounts of resource to do that. It's a marginal change at the moment. I'm giving them the benefit of the doubt. I would like to see them move quicker, and I would like to see them move in a more ferocious way. But they, you know, they are turning the tank around. It's not far enough yet, but you know, early signs of the moving in the right direction. Or it could be greenwashing. I mean, it genuinely could be like, yeah, we're doing this and paying lip service to it so that, you know, we can sell these green badged products. And look like we're doing the right thing. But I'd just like to pick up on the stuff that Rebecca said about the voting with this thing at LNG. I think that's absolutely brilliant, absolutely fantastic, because, you know, one of my beefs is there's not a lot you can do with equities. You know, when you buy an equity, you get basically two things: a right to a dividend and the right to a vote. If you can use that right to a vote as a private individual, you should use it. You know, that is how you really align your values with your equity portfolio. You can sell and things like that, or you can engage and you can try and vote directors off that don't do what you tell them, you know, what you want them to do, things like that. That's what ownership is all about. So I think that that approach is absolutely fantastic, and I'm very excited to hear about it here for the first time.
Thank you, David. I'm going to come to you, Jill, because what's happening in my mind here is I'm hearing you all speak as I'm seeing a future world in which individual investors are empowered to really align their investments to their values, to vote on companies, to vote off directors from boards. How do you think that'll go? So, you know, we've got a customer base at the moment where, like you said, most people don't even know that they're invested if we're talking about their pension fund. Most customers, I think it's something like 90% of pension customers just stay in the default because they don't realize that they've got the power to make investment decisions. You know, what are the types of things that you've found out kind of launching this platform into the world to make the world a better place? How can we help customers go on this journey? And I guess picking up on Rebecca's point that she made earlier, maybe it's not all that hard. Maybe we just make it sound really difficult and perhaps we need to get out of our own way. Over to you.
Yeah, I think you're right. I think a lot of the time we do need to get out of our own way and not necessarily believe all our own hype in the financial services industry about how difficult things can be. For me, it comes down to 3 key things: access, support, and choice. And how complicated you make that or how simple you make that is completely up to you. I think that we're really focused on making it as simple as possible for people. And that can be difficult, right? Because you're faced with a set of data or, you know, a whole load of text that for a retail customer is sometimes difficult to understand. So what value can we add to that process to make it easier for customers to understand, both in terms of accessing it, then giving them the right amount of information to help them make that decision. And that changes between persons, so you need to layer the information. So I think that's really key. And then I think giving them choice is really important, but not necessarily. One of the main reasons people don't tend to invest is because they get so much choice. It's like so overwhelming that they don't. It's not because they don't understand it. It's just like, right, I've got 50 choices now I need to make. And actually, really what it boils down to is 3. What kind of risk are you willing to take? What kind of experience are you willing to have in the process of your investment? And is where your money invested align with your values? It's not actually that difficult. So I think for us, we've really focused a lot of time in trying to keep that as simple as possible, but not losing the substance, which is also important. So it's a fine balancing act. I think there's lots of, one of the key things that I think will resolve this is technology. I think that the more we can use technology as a way to both raise awareness, make it easy for people to have their say, whether that be through voting or even just education around what engagement means. One thing that I've always found in the asset management industry is they're not actually that great about promoting the work that they do on that front. And I think that that would be a real connection between the retail customer and the asset management community if they could see, I don't just give you my money and you sit in your desk looking at all these fancy screens. I actually give you it and you're going out to visit companies and you're finding out what they're doing in their supply chain, and if you don't like what you see, you're voting against it. I think that that's something that needs to be more visible, both to whether it's David's pension clients or whether it's a retail customer with an ISA. I think that's really important that they can see that, because it's a huge value add in terms of change that can be driven. So I think there's lots of things we can do, but I think technology is going to have a huge part to play in getting this really integrated into how people's experience is with whether it's their pension, their ISA, their junior ISA for their kids, whatever it may be. I think that technology is the key to it.
Thank you, Jill. So I am conscious that we are coming to the end of our session and we have not spent a significant amount of time talking about data or the lack thereof, or even regulation, which is quite surprising given that those are normally the 2 really big topics when we talk about this kind of stuff. Although it's quite pleasant actually, because I think we can all agree that data is a problem, but it can also just stop us from doing what needs to be done. But in terms of regulation, Alex, I'm going to come to you. So we've talked a lot around and then I'm going to come to you all for your kind of wrap up comments, just so you know. Alex, we've talked a lot about direct customers, direct investors. We've talked a lot about institutional investors. We haven't really talked very much about advisors. And they're going to be in this wonderful position where they need to try and understand the customer's values and then help them figure out the right kind of investment for them. And it's not really a conversation that they're used to having. So what is the FCA doing in this space? And what are your expectations around how advisors are going to navigate this with their customers?
So I don't think actually my answer to that changes much from what I said before around the fact that actually we need to make sure that there's the right information flowing throughout the chain. And if there's an advisor in that chain, that information needs to enable that advisor to have a really good, honest, sensible conversation with their client to make sure that actually they're recommending something that's genuinely aligned with both their financial and non-financial objectives. It's really interesting. It's such a shame we're about to be timed out on this one, Kaisie, because we spoke quite a lot at the start about the information that will enable a consumer or an investor to really understand where they want to put their money. We kind of then got onto the, okay, now you invested, how can we absolutely leverage that to make a positive change within companies? And the bit that we kind of haven't quite got to, but it's also really important here, is around actually there's an ongoing reporting as well. You know, I think we've seen through investments that the reporting against financial objectives is well advanced, but reporting against non-financial objectives, particularly in the sustainability space, has got a long way to go. And so actually that brings us right into the bit where we haven't got to, which is things like metrics. And I think there's something around that we need to continue to explore, because people aren't static. As the world is moving around us, as society is changing around us, the last 6 months prove it. People's priorities and focus will also evolve. And so making sure that they have that ongoing information to continue to really scrutinise, put pressure, work out whether the investment's still right for them is also equally important.
And I guess, Alex, that applies not just to sustainable funds, but to all funds everywhere, to start talking about their impact on the world around them, not just their financial performance.
Yeah, I mean, to be honest, we could probably take some of our conversations and we could take the word sustainable out, and it would absolutely be applicable in a wider context. But yeah, I come back to the point, this is a really fast growing market. We're seeing lots of societal drivers that consumers are more and more interested now in sustainable finance, green investments, etc. And so it's probably as important as ever to get it right in this space.
Great, thank you. And I just plant a thought in some of your heads that strikes me, again, back to that conversation with my children. So if you're not investing sustainably, and if you're not investing responsibly, what are you doing? Does that mean you're investing irresponsibly and unsustainably? And maybe we should have those labels instead of just letting people think that there is investing and then sustainable investing. Maybe it would hit home more if we put health warnings on unsustainable investments. How many people did the tailings disaster kill? How many gallons of oil have gone into the sea from your investments? Some provocations ahead of your last comment. I'd like to thank you all ahead of your last comments for joining me on this panel. It's been a great conversation. I think we could continue for quite some more time, and we've had some wonderful questions through, and my apologies to those watching us if we didn't get to your question. I think it's definitely a big topic and one that seems to elicit very strong views. So I'm going to go around and come back to you last, Alex, because we did just have a chat with you. I'm going to start with David, come to Jill, then Rebecca, and then Alex for closing comments.
Thanks, Kaisie, and thanks to all the other panelists. Yeah, I think although we've had a very lively debate, I think we're actually on the same page in many ways. You know, I agree with everyone on the absolute need for transparency. People should know what they hold, but also, you know, look to the processes and philosophy behind the fund that you're holding, especially in the defined benefit schemes, where we do have to hold maybe a broader set of assets than the private client schemes that you might hold in an ISA or a DC scheme. So, you know, challenge your DB provider on the processes that they're using, their approach to RI, their approach to engagement, and things like that, more so than necessarily specific individual holdings, and you probably get better outcomes.
Great, over to you, Jill.
Yeah, I think, yeah, like David said, it's been a lively debate, but I do think broadly we're all on the same page. I think that the thing for me is that this is a brilliant opportunity to both raise awareness of where people's money's invested, help them make an informed choice about where they want it to be invested. And I think that we could moan about the data, we could talk about the problems, but I just think it's up to us to resolve that, right? We find a way to resolve that and we come up with a solution that's the right thing for customers. I know I keep banging the drum about transparency, but I think that that's the only way that we're really going to get it, and the same that we've had it with fees and other things to do with investments. So yeah, for me, I'm just really hopeful that all of the movement around this is going to create much better customer outcomes and better outcomes for the rest of society and the planet. So I'm delighted to take part today, and let's think about all the positive things that we can do.
Thanks, Jill. Rebecca, over to you.
Yeah, thanks. I think we're in just like a really exciting time right now, because people are waking up and they're starting to realize where their money is going. There is awareness growing, and that is pushing the industry to do things. And technology is absolutely the answer. That is going to be the bridge between the average person and the industry. And things like the big exchange, which I don't think anyone has spelt out, but it's the first ever impact investment only investment platform. Everyone sign up because it's great. And then also Ticker, who I've mentioned before, who are doing some really awesome stuff in impact and passives and they do these wonderful seminars where they get young people in with free beer and free pizza and tell them about impact investing. And they have a hilarious podcast, and it's an app, and everyone wants an app, and it's really fun, and technology is going to do that. Proof of Impact is this incredible company that's using blockchain technology to completely revolutionize the way that companies can report, touching on that data issue. So they can actually use incorruptible blockchain ledger technology to report the impact they're having to asset managers. That is a game changer. Franklin Templeton right now is backing it. If that's rolled out, that will just be huge. So yeah, technology is absolutely the answer to connecting people with their money, for sure. And thank you, everyone. It's been a really great chat.
Over to you, Alex, for our final comments from the regulator.
It really has been a fantastic debate. I cannot believe we have whipped through the hour so quickly. Look, fundamentally, I think some of the key themes here are transparency throughout the whole chain. Make sure that people can make genuinely informed decisions about where they want to put their money, and then can exercise pressure. And look, it's very easy to turn around and say, oh, it's the regulator's job to make sure that we get this right. It's all of our job to make sure that consumers can genuinely trust the sustainable investment market. And I think we all want to work together towards achieving that goal.
Brilliant. So a final comment from me, if I may. It's been wonderful to have this panel. It's great to be talking at the Ethical Finance Conference, and it's great to have had this conversation about the role of Adam Smith, and remembering that he talked about the moral sentiments of man before we started talking about the free hand of the market. And I think in our discussions, it's really important to remember, and we've certainly talked about it today, that money is not the end in and of itself. People want to express their values, how they live day to day, in how they align their money with their investments as well. Such an important thing to remember, and we're trying to get there as an industry, perhaps easier for individuals to do and much harder for institutional investors who have to try and aggregate the morals and values of millions of customers all at the same time. But certainly challenges that we need to overcome if finance is going to be seen to redeem itself after its terrifying impact on our economy during the crash. It now needs to get its act into gear and make sure it's the engine of our transition to a low carbon future. Not a small challenge.